This is Samsak, and in this video we are looking at how banks work. So first of all, let's look at how banks make money, as there are three ways that banks make money. Now the first one is net interest margin. So banks work by paying its customers to lend them money, and they pay them by giving them interest on savings. Now this money given by the depositor is used for loans to other people, such as mortgage loans or just a simple loan for a company. Now in this loan there is interest, and this interest is greater than the interest given to customers. So to make money for itself, the bank will therefore keep the difference. So for example, when people don't pay off their credit cards in full, they are charged interest on the balance of their credit card. The next way they make money is interchange. Now every time you use your card in store, the merchant has to pay a small percentage of the money to the bank that issued the card. So for credit cards, this is around 1.7%, whilst for debit cards, it is around 1.1%. Now there are also fees that a bank will charge you, and these include things like overdraft fees, late payment fees, and ATM fees. Now the costs associated with banking include running ATM networks and paying banking CEOs all cost money. Now around 50% of bank costs come from maintaining branches. So the next thing we need to look at is how do banks become insolvent? As there are two ways that banks can become insolvent, and the first one is known as balance sheet insolvency, and the next one is known as cash flow insolvency due to a bank run. Now we'll start off by looking at balance sheet insolvency. Now initially the bank is in a financially healthy position and their assets are larger than their liabilities. So this means that there is a large buffer of shareholder equity. Now this is the amount left over if all the assets were sold off to pay off all the liabilities. However, some customers will default on their loans, and initially this is not a major problem for the bank because they can absorb loan defaults up to the value of its shareholder equity, although shareholders will lose some of the value of their equity. However, if it becomes certain that bad loans won't be repaid, they may be written off and removed from the balance sheet. So this means that as the bad loans have wiped out the shareholders' equity, the assets of a bank are now less than its liabilities, and this means that the bank is insolvent. The next one is cash flow insolvency due to a bank run. Now this type of insolvency is caused when lots of people start to withdraw their money from the bank. Now this may be perhaps due to a panic or fear that the bank will cease to function in the near future. Now banks hold a small amount of physical cash, and this can easily be depleted. They also hold an amount of reserves at the central bank, which can be electronically paid across. So the withdrawals can therefore continue until the bank runs out of cash and central bank reserves. At this point, the bank may have some bonds, shares, and other liquid assets that can be sold quickly in order to continue repayment. Now this simultaneously reduces the bank's liquid assets and its liabilities in the form of customer deposits. However, although this means that the bank is still solvent, their assets are now illiquid because all the liquid assets have been sold. Now these illiquid assets are very hard to value, and if the bank wants to sell them quickly, they would have to offer a discount. So this means that the illiquid assets are sold for a fraction of its true value, and this can make the bank insolvent. So there is something now called the deposit insurance. So for a bank, being insolvent means that it cannot repay its depositors because its liabilities are greater than its assets. So the effect that an insolvent bank will have depends on whether it has deposit insurance. So the first system of deposit insurance was established in the US after the Great Depression. Now it had the purpose of preventing the bank runs that contributed to the depression in the first place. So the idea is that an insolvent bank will have its assets seized and sold off, and the depositors are then fully reimbursed using the funds raised, with the taxpayer making up any shortfall. So this means that the depositors know that their money is safe no matter what, and they will not bother withdrawing their deposits if there is a panic. So this will stop bank runs spreading and the mass sell-off of assets. Now a negative with deposit insurance though is that depositors don't have an incentive to monitor their bank's behaviour, and they therefore choose the bank with the highest interest rate. However, the banks with the highest interest rates will also be the ones taking the greatest risks, and this leads to a greater chance of a financial crisis and bailouts of banks. So thanks for watching. If you click on my website link in the description, there is a link which will give you a free share of up to £100 if you follow the instructions. But thanks for watching and see you soon. Bye.